You check your investment account and everything looks fine. Your balance went up last year and you just received a tax refund. But underneath that surface, 3 fees are chewing through your returns. It is like having termites in the frame of a house, while the fresh coat of paint still looks perfect. Plugging a leak of just 0.5% in your portfolio can salvage $100,000 over your lifetime. The daily movements of the stock market get the headlines, but these structural costs are statistically more dangerous to your wealth than market volatility. The first hidden cost is the fund expense ratio. Every mutual fund and ETF charges an annual fee as a percentage of your total investment. It never appears on a bill. It is deducted from your returns without a trace. A typical managed fund charges between 0.75 and 1.2% every year. An S&P 500 index fund, like VOO, charges 0.03%. This chart shows a $100,000 portfolio growing over 30 years at an 8% return. When we apply a 1% fee, the final balance ends up significantly lower than the portfolio with a 0.03% fee. The fund with the 0.03% fee costs you $3,900 over 3 decades. The 1% fee creates a $126,000 penalty over that same period. Small percentages are often used to disguise the total dollar extractions taken from your account over time. The second leak is the financial advisor fee. Many advisors charge 1% of your total invested assets every year. On a $500,000 portfolio, you pay $5,000 per year for advice. Over 20 years, that 1% advisory fee accounts for over $200,000 in lost growth. This fee is justified if an advisor saves you from panic selling during a crash or handles complex tax planning. For most investors using a simple 3-fund index portfolio, paying a recurring 1% fee is redundant. Standard financial advice has become a lifelong subscription for a task that can be automated. The third leak is cash drag. This is money sitting in your brokerage account earning nothing while waiting to be invested. Idle cash often yields only 0.01%, while the historical market average is closer to 8%. Leaving $10,000 as cash for 1 year costs you $800 in forfeited returns. This is momentum stalled while the market moves ahead. Inaction within a brokerage account effectively functions as a high penalty fee. We can now calculate the cumulative mathematical drag of all 3 factors: a 1% fund fee, a 1% advisor fee, and 5% in idle cash. A $200,000 portfolio subjected to these combined factors loses over $400,000 over a 25-year period. This loss is greater than what the average American pays in federal income tax over that same 25-year window. These hidden structural financial costs destroy far more personal wealth than the taxes you see on your pay stub. To fix this, first move your investments to low-cost index funds with expense ratios under 0.10%. Second, evaluate your advisor. Unless you have complex needs, a robo-advisor at 0.25% can handle the same basic management. Third, enable the Auto Invest feature on your brokerage account so cash never sits idle after a deposit. Perform an audit on your investment accounts tonight to check for these specific leaks. Long-term wealth relies on systematically eliminating the invisible mechanisms draining the returns you already have.